2022 was the year of outperformance for Indian equity markets in the face of a host of issues like geopolitical concern, heightened inflation, Fed rate hikes, and global recession fears. Amidst all of this, markets stood tall. But how different would 2023 be? Let's actually find the answer to this question from the CEO of the largest AMC, Mr. Nimesh Shah of ICICI Prudential. Hi there, I'm Nikki and I'm in conversation with Mr. Shah. Thank you so much for joining us.
Thank you. Thank you for having me over here.
I'm going to start off by asking you about your assessment on your markets, given that the macroeconomic situation still remain uncertain.
We are, if you know, overall, ICICI Prudential has always been talking about mean reversion. We don't get excited very fast when things are going well, and we don't get disappointed very fast when things are bad. So we don't think in terms of calendar years per se, right? We think more in terms of a business cycle. So we look at a 7-year cycle in any industry, and cycle-wise, so there are a lot of plus points for the next 20 minutes as we discuss. There are a lot of plus points that are happening across the country, right? There are a lot of good things happening in the country, and there are a lot of risk factors that come from the external world. Right. So that was 2022.
Right.
And that continues in 2023. Nothing has changed. Right. So there are a lot of opportunities, but the markets, and there is also a factor of valuation that you put in. So if I put it into perspective, I think Indian equities overall have matured a lot. What has happened in the last 3 years is that we have matured a lot. Earlier used to always worry about, in fact 2022 changed our way of thinking. We were always extremely worried as to what will happen when the FIs are selling.
Right.
Though I'm managing a mutual fund and I was seeing the regular flows in, the Indian investor completely behaved way beyond our expectations.
Right.
Because as $5 billion was being sold between October 2021 and June 2022, every month $5 billion was getting sold.
Right.
If you would have told me in October 21 that if this is what is going to happen for the next 9 months, I would have given you the market would be below 40,000, right? That was what I would, because $5 billion every month was being sold. But the Indian investor kept on investing with us, right? The Indian investor has behaved so maturely. So the bottom, the market falls 5%, the Indian investor is flowing in.
Right.
So Indian investor has gone are the days where he goes into a shell when there is a correction.
Right.
He comes out every 3, 4, 5% correction, you just see the investors coming in.
Right.
So imagine this guys, the foreigners sold so much, almost 3,10,000 crores they sold in those 9 months.
Right.
And Indian market fell only 16%.
Right.
And after that they bring in 60,000 crores.
Right.
And the market goes up back to the same level as it was.
Right.
So the whole, as far as mutual fund expectations are concerned, we are completely amazed by the Indian investor.
Right.
And his resilience to, so no longer there is a fear of foreigners selling off suddenly.
Right.
Because we know when foreigners are selling off suddenly on 4% correction, on 5% correction, our inflows start coming in.
Right.
And another thing has happened is that balance advantage fund have become very big.
Right.
As an industry, so the mutual funds anyway go to buy.
Right.
As soon as the market starts falling, naturally those kind of funds keep on buying funds. So we are very, Indian equity market are structurally very different from the last 10 years. So we don't look at the last 10-year averages, don't scare us as much.
Right.
But at the same time, we understand those uncertainties that you talked about, the geopolitical uncertainties that were present in 2022. But maybe the world has learned to manage those better. Right? We are very clear as to, reasonably clear of what will happen in the West, what will happen in US, and how the Fed is reacting is more or less in a structured way.
That's exactly, Mr. Shah, that I was actually going to talk about. You know, there is this whole consensus building in that there's going to be slower rate of Fed hikes in 2023. Probably that's a certain amount of probability that most of the analyst community has factored in when talking about the corporate earning growth for the year, which is expected to be around 15-16%. Do you think that would be a driver going forward in this year? Do you see things differently? What are your projections looking like?
So I understand one thing, again I come back to the original point that the foreign investor who was 21% of the market is now 18% of the market.
Sure.
right?
Shrinking
This
pie.
is I'm not saying shrinking pie, but I'm just putting this one. India's importance. I was in US in the last 6 months. I've gone couple of times to US, and when you meet asset managers in US, suddenly nobody in US was ever. They only invest in emerging markets. If you see US investors, they are not country specific guy. Europe talks about country specific. US has always talked about investing in emerging markets. Suddenly those guys are talking about was there an interest? There is an interest in talking about an India only fund. There is an interest about talking about a fund emerging market without geopolitical risk.
Right.
So then what remains if 30% is China,
Right.
and if people are looking at an option,
Right.
and people are looking at Asia ex China or emerging market ex China, then India exposure, which was 8 to 9%, is now 15%. It can only go up when this kind of, so it is not a one day journey as far as the foreigners are concerned. I feel foreigners' journey of investing in emerging market ex China is a 3-year journey, and that will have a significant impact on the inflows into the country. Right? So the whole, while there is a risk of Fed or whatever Fed does over the
Right.
next 1 year,
Right.
but there is also a geopolitical angle to it, and will India benefit? And I can clearly sign between the two visits of mine, one in May and one in October. Also, I see the difference with which the US investor is looking at this country. Right? His interest is much more in India than what it was 3 years back.
Right.
So I'm finding that more than the what happens in the US economy, because we have talked about decoupling and coupling a lot in life. So while we can say the economies can work independently of each other, but the financial markets, if the as US interest in India will grow, and the we are already at a lower level on FII investment, that is an opportunity as I look at it.
Right.
So Indian interest in specific India, what sell-off we saw is because of sell-off in emerging markets also.
Right.
But China is not going to be always the way it is right today.
Right.
So as China comes up, as more flows get into emerging market, there is a theory that it is India or China. But when flows come into emerging market, China also goes up and India also goes
Right,
up.
right.
And when flows go out, China
Right.
will also correct and India will also correct.
That also is
So-
something which played out exactly in the first half, right?
So-
We saw that
so-
emerging markets sell off.
So, but there will be, at some point of time, people will start buying China also. It's not that people are never going to. So, we are at ICICI Prudential, we always believe in reversion to mean. So, it's not that the world is never going to buy China. At some point of time, the world will come back and buy China also, and that does not affect India. So, we are sitting on opportunities as far as flows are concerned, and that I am very, very bullish on rather than anything else.
So you expect flows to be really positive in this
It's a
year?
3-year journey. I'm not talking about in the next 3 months, I don't know what is going to happen.
Right.
But I am saying that overall foreigners, the way they look at India, because of the geopolitical stability that we are talking about, vis-a-vis say any other country, as people are getting concerned, whether China plus one or whatever we are talking about, that happens in the investment space also.
Right.
That's what I'm saying. That investment space, people are looking at something without China, because the people perceive India to have lesser geopolitical risk than they see it in other countries.
Sure. With that conviction that you're looking at right now for Indian markets right now, the financial markets, let's just zero it down for a moment to equity markets and talk about the sectoral preferences which have been playing out. Because you're saying that geopolitical concerns will remain as they are, or probably will play out in the way they're supposed to in 2023, and India to an extent remains unaffected. But with this in the background, which are the sectors do you think you would pick? Now, would you go for something more domestic oriented, or something which is cyclical, something which is more export oriented?
So as you know, we one thing is very clear, and one thing that banking industry or the financial services industry is very beautifully placed in terms of the expected growth also, and in terms of cleaning of the balance sheets also.
Sure.
So we are talking what we had said in 2022, we continue to say in 2023, that as far as the banking space is concerned, since a lot of balance sheet cleanup happened by 2018-19 in those phases, we are into a beautiful phase where we don't expect, and we have been talking to a lot of CEOs, a lot of NBFCs, you don't see that kind of a asset quality problem coming into the banking scenario for the next 2 to 3 years, right? And the credit growth in the country is growing. So while the NIIs can be under pressure going forward, but still the volume growth will be very helpful to the banks. So I believe over the next 3 years, if you ask me, the banking sector looks like a very good sector to play in. So that is one very clear, this one. Another thing that we like a lot is whatever has not done well in 2022. As you are talking about 2022 versus 2023, we are clearly players who, since we believe in reversion to mean, if technology has not done well in 2022, we are quite bullish on technology and investment. It may not do well for the next 3 months or 6 months, but if I have to take, when I talk as a mutual fund CEO, I will always be taking a 3-year perspective.
Right.
So whether it is banking, whether it is technology, whether it is pharma, whether, so those are the kind, or whether it is the capital goods industry, whether it is the real estate. We are May 2024, we are going to see an election. I think real estate in this country has come out of a very weak 7 to 8 year cycle, right? So again, it is real estate works in a 7 to 9 year cycle, right? So I think we are the beginning. We have just seen 1 or 2 years of good real estate. I think it is a phase. Anything connected, we came up with a real estate fund also. It does not only invest in real estate, it invests in anything related to the real estate sector.
Right.
So I believe that in this country, looking at the where we are placed, whether it is banking, whether it is technology, pharma, infra space, or anything related to that is real estate, I think those are the sectors to look out for.
So when you talk about technology and when you talk about banks, if I may further ask you, there is this whole PSU banks which have done a lot well in 2022, and you said I like to prefer sectors which have not done well. Are you saying that private banks will make a sharp comeback in 2023, and also your word on mid-cap IT space?
We have always believed that fundamentally strong companies and couple of banks in the public sector, but where is the growth going to come from?
Right.
I am just saying, when I close my eyes and see a 20-year-old guy sitting in Kanpur, where will he opening his bank account? Right? Will he want a very technology savvy? Will he open in his bank account in a technology savvy private sector bank, or will he open in a technology savvy government bank?
Right.
Right? Where will the 22-year-old guy going to do his banking from?
Right.
That's where I think. So we have always got this view on private sector banks.
Right.
I think we have got some of the best balance sheets in they have got good balance sheets, opening balance sheets, and they have got strong market share growth. We like to invest in businesses which compete with government organizations, right? When you are competing with a government organization, I think those businesses are good businesses in our mind. So we like the private sector banks in the country who can raise good deposits. I think next 3 years is going to be a war on liabilities for anybody who's in the business of lending, right? He has to ensure that his source of the raw material, what is banking? Ultimately, there are two things. Capacity is decided by the capital, and capital is immense in the country, and from foreign countries also, capital can come in as much as you want. The main shortage in the banking would be raw material. So raw material is nothing but deposits, right? So any bank which has got a strong CASA franchise, right, who can raise deposits, is going to be the winner over the next 3 to 5 years, because ability to raise CASA will ensure that the NIIs are in a good state. So I am quite bullish on the banking sector where people have the ability to raise low cost deposits. And some of the private sector banks have created a great franchise in the market.
Okay. Your view on the valuations right now, because we have been trading at a certain amount of premium compared to the emerging markets, is almost 70% as compared to the historical average of 40% roughly that we've been reading through. What's your assessment?
I completely agree with you that relatively India looks expensive. When suppose you are a fund manager sitting in Europe, or you are a fund manager sitting in Hong Kong, Asia looks much cheaper than India. So even we are advocating that people should invest in our ICICI Prudential Global Advantage Fund,
Right.
where we invest in across Asia. We invest with our competition funds also in those, where there is a Asia fund, there is a Japan fund, there is a China fund, right, through Hong Kong. So I think Asia relatively to India is at a better valuation level, and it makes a lot of sense. And Indians should also, this opportunity is available right now. My window is open. So it has not done well in the past. So I'm coming on your channel telling people to invest because China has not done well, Japan has not done well. We have invested in those countries.
Right.
Please invest in ICICI Prudential Global Advantage Fund with a very bad past track record. Right?
Oh,
it is because that fund of fund could not have done well because it has invested in those countries. So we are, I think valuation wise, these countries are better placed than India today. So India has its own advantages, and as I said that there are flows that are talking about us, but Asia investments without India also look good.
Sure. So you expect the valuation and the premiums to continue to be as they are for 2023, because a major part of it was the driver for 2022. So what do you think will be the situation now looking at it? Do you expect the markets always to be at premium, or do you think there could be a change now with if there is a slowdown in the corporate earnings growth?
I will look at this at two different angles. One looks at it. What you mentioned was vis-a-vis the rest of the Asian countries.
Right.
I agree with you. Rest
Right.
of the emerging markets, are we expensive?
Yes.
We are expensive. We are the only country which has given return over the last 10 years. In the emerging market, there are only two countries if you see the last 10 years,
Right.
there are 2 or 3 countries which have given positive return.
That's true.
And our return has been very good, even in dollar terms. We have
Right.
given more than 100% return in dollar terms over a 10-year frame. So people like to invest in India. That is why India is available at a premium. So will the premium decrease? The premium should decrease because it is not that people are going to take money out of India and put it somewhere else. I believe that there is enough money in the world that the other Asian countries will get their inflows this year. Right? That's what
Right.
my belief is. So
Right.
one is valuation vis-a-vis other countries, but then there is a valuation within the country. India does not look that expensive. When you look at our historic average, are we 10-15% more expensive than what we were for our last 10 years history? Yes, we are. Right? So we are slightly expensive. We are not majorly expensive.
Right.
We are at a slightly expensive level than in the past. But in the next 2 years, we expect a double-digit growth in EPS also.
Right.
Right? How many countries in the world will you say that next 2 years there will be EPS growth over the next 2-3 years?
Right.
Right? That is where India has got a great advantage. We have got a diversified industries which the world understands. We are not very heavily loaded towards one industry. So we are going through a very good business cycle. We are at the bottom of the business cycle, and we can do only better over here. There are lot of macro advantages to India.
Right.
Which we have as a country. So I don't believe, and with the flow support that we are getting today, there is not much downside to India. Having said that, 2023 will be a year where debt and equity won't make much of a difference where you invest in. You should not be ignoring debt also. Debt, interest rates are rising in the country. Okay. My credit risk fund is giving a much better return than what it was giving 1.5-2 years back. People will start looking at debt also. 2 years back, there was a case, the interest rates were so low that people were talking about the TINA factor. There is no alternative but but equity.
Right.
Today, debt is becoming a very good alternative for people because interest rates are rising.
Right.
So over the next 3 years, I believe debt investing will be back in this country big time. People will invest in debt mutual funds, and we are proposing that people should invest in debt mutual funds. People should invest in multi-asset investments. And our investors, we are always telling them that instead of doing, because of the valuation levels that we are in right now, it makes to invest over the next 12 months. Instead of giving us money in equity right now, divide it into 12 parts and do a systematic transfer plan into equity. Put in one of my debt funds, and over the next 1 year, systematically move into equity. Because then you are averaging out throughout the year, because you know the uncertainties that are there in the market today.
Sure, Mr. Shah, this is the strategy that the AMC is looking at on a broader perspective for 2023 in light of the Fed rate hikes which have come through or will come through. Now the consensus is building in an estimate of slower rate hikes. So do you think as an AMC your strategy will align or change based on the situation, or you have a very a long-term perspective, like a 3-year perspective, and which are the pockets you think with this would be more attractive?
Our perspective is a business cycle, and a business cycle is 7 years plus.
Right.
So we don't look at, so that's why I said that we would make our investment with a business cycle point of view over 5 to 7 years. That is our mindset. So these are the sectors that I said: banking, technology, pharma, which interest us, and real estate. These are the 4 sectors that I talked. Anything related to real estate.
Right.
So these are the sectors that I told you that we are bullish on. And because I believe that we are slightly highly valued, we are 10 to 15% highly valued. That is why I said invest over the next 1 year to make money over the next 5 years.
Right.
That's what I was saying. That instead of doing one-time investment right now, either go for the balance advantage category that one has created, right? And now the whole market has got a balance advantage category. So I'm very happy with that category overall. So either invest through a systematic transfer plan over the next 1 year. The whole of 2023, one should look at investing and not harvesting, right? So 2023 is for investment, for money to be made over the next 5 years.
And that segment is clearly where the traction is
That
for
is
this
all
year.
asset classes. So that's why we have got a fund which is now almost 18 years track record, which is called ICICI Prudential Multi-Asset Fund.
Right.
Right? It invests in equity. Almost 65% will be invested in equity, around 25% will be invested in debt, and there is an investment in metals also. Right?
Oh.
We can invest in gold, we can invest in silver. A lot of our funds were able to take the exposure to silver and have made good returns out of it. So it is an era of multi-asset class investing.
Clearly.
So 2023 I clearly see as multi-asset class investing, and not only equity, debt, metals, a lot of metals are at all-time low. Some
Yeah,
of our funds,
exactly.
some of our funds are also invested in that, right? So
So you're actually going bullish on the metal space again, especially
We
after
are-
what we've seen in 2022.
see, there is while metal prices have corrected,
Right.
and we have always, in 2019 also we had invested in metals, we made money in 2021, right?
Right.
So metals will go through its cycles. But see, one has to understand everything is stock specific now. While we discuss broad, 2023 is a year of stock pickers, right? Even in metals, can you identify a company which has got very good governance structure? Suppose it is in aluminum, right? And very good governance structure, but it would have an acquisition, and if you go inside that aluminum company, it is not only aluminum, it has gone into it has acquired, which is into downstream products. Downstream products need not be commodity, this one. So even when aluminum prices fall down, people see over a period of time this company has got a very great stability in profits.
Right.
Right? Even with aluminum prices, because if you are making cans, right, out of aluminum, then your profitability is in fact improving. So over a period of time you will see that people will realize that our companies may not be only metal companies, they might have value added. So you cannot be, I am saying this market is such that I cannot say I am negative metals or positive metals. Ultimately story will be corporate wise.
Sure.
Right? Within metals you will have lots of opportunities. Right?
So
that's what I feel. That's what I feel.
That's like a no-brainer with you describing the company so well for it to be
I'm
turned
saying
out
there
to a
would be-
specific name. But
There would be many opportunities in every industry. Pharma, when I say pharma, do I mean that all pharma? See, it's not an era of index investing. There was a time where you invest in an index and you make money out of that index investing.
Right.
Whether it is technology or pharma, will you make money out of index investing, or will you make money out of specific stocks in that industry? I think this is a time. In 2020, you could have touched anywhere and you could have made money out of this index investing.
right.
I think 2023 is going to be a stock specific story. I'll give you an example. We have got 2022, the market gave only 4 to 5% return, right? The whole of calendar year 2002. But if you see some of our PMS or AIF, which are very great stock pickers, right, in that, if you see some of our PMS or AIF, they've given much higher return.
Right.
Because they don't disagree with the macro story. But their mindset of those fund managers is that I don't have to look at the entire macro. Within that entire macro, where are the opportunities, you tell me. Right? I have to pick up 20 stocks whose earning per share over the next 3 to 5 years is expected to increase.
Right.
So they have been able to invest in a low valuation stock,
Right.
where there is growth.
Right.
And where growth is expected over the next 5 years.
Right.
So are those companies available? Those companies are available. So our research arm becomes more and more important in phases like this. This has happened in the past, and if you see, we have done very well in this phase. If you see the last 1 year, my track record in the last 1 year has improved for 3 years, 5 years, for everywhere it has improved, because in a low return environment, our kind of fund management does very well.
Sure, we're going to chat about it in detail, about how we've grown, the whole AMC journey. But before that, I'm going to touch base on the union budget, because it comes amidst a fear of a lot of pressures externally, right? You would see the geopolitical concerns, you're seeing the slowing economy, you're seeing a bit of everything which is playing out and impacting. What do you think at this point of time are the themes that you would like to keep an eye out on in the budget? And also a word on the rationalization of the structures of the capital and the long-term capital gains. I think I've posed a lot of questions.
So you have covered the whole
3.
economy. So I see budget is into 3 parts. One is the macro numbers, how the government takes care of the fiscal deficit, to what extent they play. I believe that the government has, since we are seeing this government since last 8 years now, it has been very, very prudent, right? Even in phases like 2020, where there was a license to print as much money as anybody wanted and the whole world did it, I think India managed it much better than the entire world. So if you see the last 8 years, and I'm just looking at the last 8 years of this government, I think they have been very prudent as far as macroeconomics is concerned and how the country macroeconomics has been managed. We are very satisfied at ICICI Prudential. We are very, very confident that this government will manage the macroeconomic situation well. Right? They are not going to be non-prudent at any point of time.
Sure.
What do you expect of a budget? That there should be prudence in the way fiscal deficit comes out, and the areas that they spend money is what is important for the country, and money is not wasted. Right? So that wise, I don't think I am the expert. I think the government has done a very good job of that. Then there is indirect taxation, which more or less is taken care in the GST phase, which is not, nothing is going to come out on that phase where the industry is maximum affected. So we have got a lot of stability in that phase now, right? So if they are going to make any changes, it's not going to be happen in this budget or anything on the GST plan, and whatever changes, whether rationalization happens over there or not, that the government decides. You see very robust collection every month. So at some point of time, that has got nothing to do with the budget. Direct taxation, the lesser tinkering they do, I think it is healthy for the country, because then I can envisage what is, so I am not that concerned, and I don't think it is a big event overall, because the government has been very rational on the macroeconomic side.
There has been a lot of chatter around the controversial debate of LTCG in light of STT, which has come in. A lot of players have spoken about it, and how either the exemption limit should be increased or how there should be a completely do away with LTCG. What's your expectation right now from the government?
See, we have to operate in whatever rules. We would always say, if we are players in capital market, we will always say that the LTCG can go away, right? Because there is STT and all, and that people have been saying for a long time. I think the government knows what it has to do, and while our expectation can be anything, they need to manage their macro numbers, and based on that, they will have. So I just expect lesser changes. I don't expect that any government is going to remove the LTCG or anything like that. I'll be very happy if there are minimal amount of changes on the direct taxation side, including LTCG.
LTCG, fair enough. ICICI as an AMC has done pretty well in the last 15-year journey that you've been with the AMC. And correct me there if I'm wrong, it's the assets under management have brilliantly grown from 35,000 crore to a good 5 lakh crore figure under your leadership. So what does it take? What are the strategies you think? What are the things you've got right to get ICICI AMC in the position that it is today, which is also a lesson that most of the investors, or for that matter fund managers, should look at while starting their journey?
No, what we have done, actually we are blessed with a very strong brand with the world trust. Right, the Indians trust. When you go to, there are very few brands in the country, and I'm not saying ICICI is the only one. There are other brands also, which is trusted. Whether you go to the Kanyakumari, whether you go to Kottayam, where you go to Guwahati, there are 2-3 brands in this country which are completely trusted by people. So we are blessed to be one of those brands where there is a lot of trust element that goes with the brand. When you are giving your money to somebody to manage, you need to trust the brand, right? So that has gone well for us, that we have inherited a very strong brand which is known across the country. And as long as we don't, this country is a very beautiful country to do business in. Market is infinite. As long as you don't make mistakes. See, I have got this philosophy: you don't make mistakes, you will be okay in life, right? And with a strong brand, right?
Right.
So it is like the country will give 6 to 7% growth. There will be 4 to 5% inflation. So nominal growth of the country will be 11%, as seen in the last 10 years also. Right? If the nominal growth of the country, the corporates will grow by around 12 to 13%. Right? That has happened in the last 10 years also. Even if you see last 10 years, the GDP, the nominal GDP growth will be around 11%. The corporate growth has been around 13%. In the EPS also, in the markets also, corporates have followed. In the last 10 years, these three figures have been consistent.
Right.
So if that is the phase that we are in as a country, if we don't make mistakes, we'll grow by 13-14%, right? And even if I say not 13 to 14%, we'll grow by 10%. Plus there is SIP, which is almost 1% of the total market, right? If any corporate, so there is a steady growth. There is a good business to be in for a bank, especially. This is a good business to be in. As the depositor graduates to become an investor, right? This is going to see, if we take the perspective, why I believe that this industry will be good. 10 years back, we were 11% of the banking system. Mutual fund industry was 11% of the banking system. Today, mutual fund industry is 22.5% of the banking system.
Right.
Right? I think by 2030 will become 1/3 of the banking system. Today, the banking system is 170 lakh crores. In 8 years time, 10 years time, it can be 350 lakh crores. Mutual fund industry, if it is 1/3 of it, will be 120 lakh crores. So 40 lakhs to 120 lakhs, that journey is facing this industry. Right? We are going to become 3 times of what we are today in the next 10 years. What has happened in 25 years, double of that is going to happen in the next 10 years. So when there is such a momentum for the industry, right? So I have got 3 eyes with me, ICICI. So one is India, second is industry, and third is ICICI. All 3 eyes are working for me. So as long as we don't make mistakes, people trust us to give us money, and their past experience with us has been good. So in this company, we track something called as happy customers at the transaction level.
Right.
So that happy customer percentage for us is so high. So that, see, a person, it's such a simple business. A person has got a good experience with you, he will invest more with you.
Right.
Right? If a person has got a bad experience with you, he is never going to invest.
Right.
84% of my sales happen with existing customers.
Right.
Right? So my only job in life is not to goof up. If you don't goof up, we'll be okay. When 84% of your customers are reinvesting with you, we should ensure that they don't get a negative experience.
Right.
So once we are able to keep the customer happy, so happy customer percentage right now is very high. So that is why this business will do well. This product is very good for the final customer.
So in all the 15 years of journey that you've had, which is the strategy which has actually helped you float? Is it the value investing? Is it the growth investing? Do you see yourself now changing your strategies and looking at markets differently? What's different in this era?
What we have done well is that we have never gone and told the world this fund has done very well in the last 3 years, please buy it. Right? Or the last 1 year performance of this fund is very high, please go and buy it. That is a shortcut to success, where people, because unfortunately in this country, people look at your past track record and only buy. Past track record, we have always said as ICICI Prudential, is only an indicator. Is only an indicator that this company manages money well. That should be only it used to. So we have never taken this shortcut of saying that, say we have got a lot of sector funds. We have launched sector funds only when that sector was in a very bad state. If you see how this company has run in the last 10-15 years, there is not a single NFO which a customer has lost money on. Right? The customer, because even when we have launched sector NFOs, we have never launched sector NFO when the sector has done very well. It is very easy to collect money because you can say past how well the sector has done. We have launched sector funds when the sector has done very badly, right? So that is the time to launch, then the customer will have a positive experience. We have never sold aggressively any of our aggressive funds. Anywhere you look at my interviews in the last 10 years, I would only have talked about balance advantage fund, right? Where multi-asset fund. That's what I talked about. We
Right.
never talk about our aggressive funds. We only talk about our defensive funds.
Right.
That please, because I don't want the customer to have negative experience.
Right.
Unfortunately, the customer comes in when the markets are at a relatively higher level. Indian customer has matured today, relatively, is better off today, where he is buying when the markets get corrected. Otherwise, at the top of the cycle, you always get a lot of money. And so we have stayed away from that. We don't aggressively market aggressive funds when they have done well in the past.
So the fact that you're actually vouching for IT sector for that matter, which has not done well, is probably, and select names from metal space, is probably one of the strategy that you have as an AMC to go for companies in the broader,
So contra-cyclical has worked for us as a country, as a company. The size that we manage today, it is best that we take contra-cyclical when you are investing, when there is a fundamentally strong company. Say a telecom company, right? We have been investing in a telecom company because we believe that all of us pay much less for the revenue. Worldwide, you don't get telecom as cheap as India.
Sure.
Right? At some point of time, from less than $1.50, we will slightly charge the customer more.
Right.
When we charge so when you do this kind of when we charge the customer more, the revenues will increase very fast.
Sure.
When you do this kind of investment, always your downside is much lesser than the upside that you can get.
Sure.
So value investing, contra-cyclical investing has all done well, and we are not one style. See, we manage more than 250,000 crores in equity. So we cannot have one style and manage. So we have got various styles within the company. We have got aggressive funds, we have got defensive funds. So the fund mandate has been very strongly working. And what we are, I believe the strong point for the last 15 years for us is that we have got a very strong risk management in this company.
Right.
There has not been a single case where whatever money we have given in form of investment in debentures also, in bonds of this one, all money has always come back on time. So I think a very independent risk management company which works independent of the fund managers in this company is what has helped us really.
Okay, so I'm going to get on to a little fun segment right now, or a lighter note. These are like, some 8-9 questions, rapid fire questions, whatever. You just have 15 seconds, whatever is on top of your mind, just shoot in that case. If not for an CEO of an AMC as large as this, what would you be, and what's your alternative career choice?
See, I have been 30 years with ICICI Group, right? This is my 30th year in ICICI Group. I have done various roles. Even before I did an AMC, I have got various business I have done, which are very different from each other. So last 15 years I have been into this one. So I've forgotten my past. What happened before 15 years, I've practically forgotten. So this is my AMC is my space.
Okay, so you can't think yourself of being
I
someone
wanted to be an
else.
equity research guy. My career aspiration in life when I was 22 was to be an equity research guy. From equity research, if I got the CEO of that company, it is a dream job. What else would I want?
That's true. Okay, one power quote you keep in mind while handling your client's wealth. Just 15 seconds on this one.
So if you see what has been written outside my company, there are 2-3 quotes outside. So one thing is that trust, it takes a lot of time to build trust, but it can be broken in one transaction.
Right.
So that is always there. Second thing, as we manage the size of the money we manage, I think the relevant quote for us has always been that discipline and not individual brilliance is going to take us forward. So as I said, risk management and discipline is what this company is looking for. And
Mr. Shah, any book that you would want to recommend to most of the people around, and especially how many books do you read in a year to begin with, and any specific book that's close to your heart?
See, the first book that I read on investment is always something that I tell everybody to read. That is One Up on Wall Street, which is a very commonsensical investment book, right? I wanted people who don't understand anything in investment and finance that book shows very clearly that you require common sense, right? So common sense, which is very uncommon,
that is true,
is what has made maximum money. So I know a lot of people who have made a lot of money in the markets, and when you speak to them, I think they are not the best financial analyst in the world, and they don't do much of financial analysis also. I think which people have succeeded are the people who have used common sense very well. So I always tell my wife that she does not know much about finance and investment, but according to me, she can be a much better stock picker than me, because she knows what will sell well tomorrow, what will work in the market. She understands much better than me. So that One Up on Wall Street, which is a very basic Peter Lynch book, is all you need to make money into the markets.
That's brilliant. Your favorite global CEO, or for that matter, a market guru that you look up to?
See, there is not one way of making money, there is not one way of running a company. So when you meet a people, thankfully in this job, you meet a variety of people and a lot of CEOs you meet. Like there are various ways of making money, right? There are various ways of managing a company also. So you meet a lot of people, you pick up the best things out of people, you think what is appropriate for a company, you pick up at different points of
Any
time.
specific individual that comes to your mind when I say that?
No, as I say, there are various things to learn from various people. So
no pick up there.
No pick up there.
Okay, your view on Mr. Musk handling Twitter. How do you see that?
We don't comment on individual company, whether in India or abroad.
How do you manage stress?
How do you?
Manage stress? Stress buster for you.
I don't get stress. I have got this dream job where I would have always wanted this kind of a job, as I said earlier. So I don't get stressed on the job. In fact, a CEO's job is maximum required. Where is a CEO required more? We are obstacle removers, right? In this company, what is my role? I am an obstacle remover. So I am required only when there is a stressful situation. Otherwise, there is a structure which is working. So I can't complain about stressful situation, because that's where, and I always like to be in the middle of those situations. So those situations don't stress me. What the others feel is a stressful situation, I don't feel stressed at all, because my job is that.
All right. Mr. Shah, we'll leave it at that. Thank you so much for taking out the time and speaking to Moneycontrol.
Thank you. Thank you.